Today we are selling the market. Holy shit, have you seen the market? It's higher than Snoop Dogg at Martha Stewart's house. The Buffett indicator, one of my favorite indicators, is 1.82, indicating that we could be 82% overvalued. You're putting in the dime and the time, you need to make it count. Hello, welcome back, and thank you for joining us. This week we're going to talk about what are we buying, which is actually kind of selling the market, but we're buying against the market right now. So there are several funds that you can buy, exchange traded funds that track the inverse of the market. So if you buy the market at 1 and it goes up 10%, these funds will go down 30%. So they actually move 3 times inverse the market. So if the market goes down 10%, then these funds go up 30%. And that's what I'm betting on. I'm betting on that the market is it's at an all-time high. Sold off a little bit today, depending on when you watch this, we're near the all-time high. Well, what does that mean? Price earnings ratio of the market right now is 38 to 1. So for every dollar that companies in the stock market earn, their stock price is on average 38 times higher than that. Historically, it's about 15 to 1. So we're over twice what the average has been in time. So the market is expensive right now. The thing that I like to follow is the Buffett indicator, which is the market cap of all publicly traded US stocks divided by our gross domestic product. Right now it's at 1.82, which means that some people would agree that we're 82% overvalued. The sum total of all publicly traded stocks are now 82% more than the gross domestic product of our country. So we're at an all-time high. Before, the old high used to be about 40%, 49% in January 2018. Before that, the previous high was March 2000, right before the tech bubble burst. So there's only 2 things that can happen. Either GDP goes up or the stock market cap of all these companies goes down. Looking at our world today and where we are with the pandemic is one indicator, or where we're at with employment is another indicator. Do you think we're going to increase GDP? Hopefully we do. Unfortunately, I don't think we will before the market comes down again. So you can buy SPXU, which is 3 times inverse to the S&P 500. The good side is if the S&P drops 10%, SPXU will go up 30%. Flip side, of course, the market keeps going up. That fund is very volatile. And so it's a short-term trade. It's similar to SQQQ, which is the similar type of fund on the NASDAQ 100, so the mostly technology-heavy NASDAQ. We also have the SDOW, SDOW, which is a 3 times inverse of the Dow Jones Industrial Average. And then TZA is another one I'm buying. It's 3 times inverse on the small cap, which kind of replicates the Russell 2000. You can bet against the Dow, the NASDAQ, the S&P, and the Russell 2000. The reason I'm doing this, again, because of the price earnings ratio, the market, and what we talked about in our VIX episode. If you want to check that out, VIX is a volatility measurement and also a fear guide. But the VIX a couple days ago was at its all-time low. It had a big gain today, but the same is true for the market. It's a contrarian move. When you're looking at going with the market, 7 years are usually up, 1 or 2 years are usually flat, and 1 year's down. Well, over the last 20 years, we've really only had about 1.5 years down, and it could keep going. I could be wrong. I called last year's drop. We started selling in February, and the market bottomed in March, and that was coronavirus related. But I was not a buyer. I thought the market was going to keep falling. So full disclosure, this isn't an exact science. But right now, when you're betting against the all-time high in price earnings ratio, and the Buffett indicator is at an all-time high, suggesting that the market might be 82% overvalued. Those are things that I think are important for you to look at least. And I would say buy small pieces. You can average into that, where we may see the market drop quickly, like we see big 600, 700, 800 point gains and drops like we saw today or we saw last year in March. And so with all investing, there are no guarantees. So another strategy, say you own a portfolio of stocks, and if you're watching this and you're looking for information, you probably do. Those stocks that you bought last year, a lot of them are up big. From a pure tax standpoint, maybe you own Tesla and you can't sell yet because of taxes, or you own Apple, or you own some of these other high flyers. One way to hedge those bets is to buy a smaller position against the market. If you sell all of your Apple today, you realize your big gain, you pay taxes on that big gain, But you still like Apple, you want to own it. Let's say you keep owning Apple and you can buy some of these funds that I'm mentioning now that make money if the market drops. It's a net neutral in your portfolio. For me, I'm selling those stocks. Just on a side note, from a tax standpoint, paying taxes is a good thing when you're making money. Obviously, we hate paying taxes and we want to pay as little as we can. But if you're paying them, that means you're making money. And if you buy ABC stock for 10 and you sell ABC stock for 15, you made your 50% gains, you're going to pay the tax. Whether you keep ABC for the next 2, 3, 4, 5 years and sell it for 15, 16, 20, you're still going to pay the tax. So I try and take taxes out of the equation most of the time. Our job is to buy ABC and sell it for more, and we'll pay the tax along the way. Of course, we'll get to tax planning and strategies, and if you're below different thresholds or you're qualifying for different things, we'll talk about that in future episodes. I usually try and take those questions out of the thing because I've been burned on that before, and investors have. Hey, we don't want to sell this stock because it's going to trigger a $10,000 gain. Well, the stock just dropped 15 grand. So we lost 15 grand on the stock to save not paying taxes. That doesn't make any sense. So this is a short-term play. I think the market at an all-time high, PE ratios at an all-time high, the Buffett indicator at an all-time high. If our economy looked great, if we had low unemployment, if we had everybody working and spending lots of money and everybody doing the things that they want to do every day, then maybe that would make sense that these ratios are so high. That's not what we see. We still see kids not going to school. We can't go to sporting events. We can't go to entertainment events. There's a lot of parts of our economy, the retail and travel industries and hospitality industries that aren't doing well. And I think they're being supported by a lot of the stimulus and some of these programs that are designed to help for the short term, but it's not a long-term fix. So you can buy SPXU to play the S&P 500 falling. You can buy the SDOW, SDOW, to play the Dow Jones falling, SQQQ, which is the NASDAQ going down, or the TZA, which is the Russell going down. Keep in mind, all three of those move 3 times the daily move of the market. So you don't want to get caught holding those in a long-term bull market. There's a lot more risk. I guess one step short of driving up to Tahoe and putting it all on black. But I think there's a short-term trade opportunity. I'm looking for maybe a 40 to 60% gain. I think the market's at least 10 to 15% overvalued, which translates into 30 to 45% gain potential and worthy of our time and your time. And thank you for joining us. As always, please like, share, and subscribe, and feel free to email me. Let me know if you agree, you disagree, or any other topics you might want to see in future shows. Thank you.